Hello everyone. In our previous session, we have seen different types of finance, that is short-term finance, medium-term finance and long-term finance. But today in this session, we will be discussing what are the various sources of business finance, means from where you can raise finance for your business. Now let us start this topic. Financing, as we know, is an indispensable factor of production, means you cannot start any business or any kind of production without finance. Every business unit, whether large or small, they need finance. It is the first and foremost responsibility of owners of the business to finance the business. So the initial or the first step or first responsibility of anyone while starting a business is to arrange for finance. It can be supplemented by loans and credit, means you can take loan from someone or you can take cash on credit from someone. In case of sole proprietorship, the individual owner of the business, what he does is that he invests his own funds in the beginning, and at a later stage he may retain a part of the profit in the business. Means suppose after starting a business and after few period of time, if the owner wants, then he can keep reserve, he can keep a part of the profit that he is earning from his business for further investment in the business. He may borrow funds from relatives, friends, etc., banks, etc. In case of partnership, the capital is contributed by partners. Now, in partnership, we know that at least minimum 2% should be there in partnership firm. So, what partners they do is that they contribute from their own the capital. It may be supplemented by loans. In addition to the capital contributed by partners, they can raise loans also. As such, there are two main sources of business. So now, from this paragraph, we knew that there are two kinds of finance or two sources of finance. First one is the own funds, owner funds or ownership capital. Means the names are different but meaning is same. That means the owner taking out money from his own pocket and investing it into the business as capital. The next one is borrowed funds, means borrowing from someone in form of loan or any other type of deposits. Now let us talk about first sources of finance, that is own funds, owner's fund or ownership capital. Now it consists of capital contributed by owner or owners of the businesses plus the retained profit. It means that the owner, whether one or whether more than one, if they all contribute some amount of money into the business, then it is known as ownership capital. Plus retained profit, means suppose in a particular year you earned 10 lakh rupees as your profit, and out of that 10 lakh you kept 2 lakh as separate for your reserve or for future investment into business, then that 2 lakh rupees will be known as retained profit. So this two type of capital or two type of amount of fund is known as owner's fund or ownership capital. Owner's funds are supposed to be risk investment. They are considered as risk investment. Why? Because entrepreneurs undertake the risk of the enterprise, because they are taking a risk of the enterprise. If there is profit, then it is good for the owner, they are going to divide it among themselves. But after investing all of their capital, and if the business suffers loss, then it is their risk to bear. They have to bear the losses as well. So it is known as risk investment. Now when we see the special features of owner-owned funds, the first one is owner funds are treated as risk capital, that is provision of loss or low profit. Means owners funds, they are considered as risk capital because a huge amount of risk is involved. Because of loss, we may suffer loss, we don't know about future, means we can suffer loss also, or we might come across the problem of earning low profit. Then second features is own funds are the permanent source of capital. Means since it is the owner himself or owners themselves, they are taking out money as capital, so it is considered as permanent source of capital. However amount of capital or fund is required by the business, the owner can give it anytime. Then third one is owner funds are different from management. Now owners funds, they are treated separately from management. Management, there might be different expert professionals to handle the affairs of business, and that management part is different from owned funds. There is no need of security for owned funds. Now when you try to take loan from any financial institution or from anyone, then you have to give security. You have to keep something there, or you have to show something that if you are not able to repay back loan, then they can take that asset in place of cash. So in case of own funds, you don't have to give that kind of security. Then what are the advantages of funds, owned funds, there is no need to mortgage assets for raising funds. You don't have to mortgage any of your asset to raise fund. Then own funds are non-refundable, so it is the permanent source of capital. Since the owner himself, he is giving the capital, he doesn't want to take refund from the business. He is happy with his profit. Then there is no interest charged on capital. Means it's simple that you are investing your own money in your own business, so you are not going to charge interest on capital. Then professional manners can be employed because capital and management are different. Since you are investing your own money, then you can hire some expert or professional managers to handle your business. Then it is a source of unlimited capital. Means no matter how much amount of capital is required by the business, it can get from the owner. Now there are some disadvantages of owned funds as well. Now let us see. The first disadvantages is due to large number of shareholders as owner of the company, control over company may diffuse. Now when we talk about company, we saw that there might be lots of shareholders. They are treated as owner of the company and they invest capital into the business, into the company. So they have control over the company. So if there are a large number of shareholders, then controlling the company or running a company becomes very difficult because the power or the control gets splitted between those shareholders. The next is being a permanent availability of capital. A part of the capital may remain idle. Means since we know that owned funds, they are permanent source of capital, we might keep a part of the capital idle. Means we may not use that part of the capital. Then the second type of fund is borrowed fund. Means we borrowed loan or something from someone else. Now these funds are received from the parties separate from the ownership firm. Means those who are in the ownership, except for them, if we take loan from someone or if we take fund from other than owners, then that is known as borrowed fund. Partnership may also procure funds through loan from relatives and friends, loan from commercial banks by admission of a new partner, discounting of bills, government assistance. Means partnership firms, they can take loan from their relatives, friends, then they can take loan from commercial banks, or when they admit a new partner, that new partner may bring some capital, plus they can take loan from that new partner as well. Then they can discount some bill, then they can take help from government as well. Companies may borrow funds by issue of debentures. Means they can issue debentures and they can raise loan. They can also borrow funds from bank and specialized financial institution. Lenders do not take risk, so these loans are generally secured. Now let us see some special features of borrowed funds. It can be raised for a specific period. Means when we take usually when we take loan from someone or from any financial institution, we take it for a specific period of time. Then there must be security for raising funds through debentures. Means if we want to raise fund through issue of debenture, then we have to give some security as well. This we will learn in detail while we will learn about debentures. Then third point is a fixed charge is made on assets due to borrowing funds. Now whenever we borrow fund, we have to keep our asset as security. So we are going to charge some amount of money from our assets for borrowing particular fund. Then borrowed funds are payable after the specified period. Means suppose if we took loan for 5 years, then we have to pay the amount after 5 years. There is much control on company due to non-interference of creditor. Means we're just simply taking loan from them. They don't take interest in the working of the business like owners. Means when owners, they invest capital into the business, they want to take decision, they try to control the business. But in case of borrowed funds, they will not interfere with the management of the business. Then let us see some advantages of borrowed funds. Now, efficiency of company increases due to fixed rate of interest. When we borrow fund, we know that a particular fixed rate of interest we have to pay on that amount of loan. So the company works nicely and efficiently to earn at least that % of interest. It does not affect the owner's control over the management. When we borrow loan from some other party, the owners, they still will have control over the business, because the lender or the creditor, they will not interfere with the management of the business. Then the last advantage is borrowed funds provide flexibility to capital structure of the company. Then there are some disadvantages. The first one is there is fixed liability for the company. Means they have to give at least fixed rate of interest on the borrowed fund. Suppose if in a particular period a company is not able to earn that much amount of profit to repay back its interest on loan, then what the lender, they do is that they used to take assets of the company. Then there is requirement of adequate security for raising funds. Means to raise a particular amount or a sufficient amount of capital through borrowed fund, at least you should have assets or adequate security up to that value. Means if you are planning to raise loan of rupees 10 lakh, then your company or your business should have assets worth rupees 10 lakh for keeping as security. Now there are sources of finance on the basis of ownership. First one is owner's fund, that is shares, and next one is borrowed funds. In owner's funds we have equity and preference. Then we have retained earning, GDR, ADR, IDR. This all we will learn in detail in this chapter. Then in borrowed funds we have debentures and bonds, loan from financial institution, loan from commercial bank, public deposits, trade credit, intercorporate deposit. Now let us see raising funds, that is raising funds through equity and preference shares. The capital of a company is divided into units called shares. In accountancy we saw that what is meant by share means the total capital of a company, it will be divided into small equal units, and each unit is known as shares. According to the Indian Companies Act 1956, a company can issue only 2 types of shares, and they are equity shares or ordinary shares and preference shares. Now let us see what is equity or ordinary shares. A share which is not a preference share is an equity share. It means that if the shareholder is not entitled to a fixed dividend in preference to others, or if there is not prior right for the capital to be repaid, the share capital will be treated as equity share capital. Or you can think like equity shares participate in profits of a company after all preferential rights have been satisfied. Means after earning profit by a company, what company will do is that first they will give dividend to the preference shareholders, and after distributing preference shareholder dividend of preference shareholders, if there is any profit left, then those profit will be divided among into the equity shareholders. Equity shareholders are the virtual owners of the company. They get dividend after payment of all the expenses and dividend to preference shareholders. Means the company first they will pay all their expenses, they will give dividend to the preference shareholders, and after giving all those things, then the equity shareholders will get their dividend. Then the second type is preference shares. Preference shares are those shares which are entitled to priority in the payment of dividends at a fixed rate, and sometimes also in the return of the capital in the event of winding up of the company. As we already discussed in equity or ordinary shares, that first preference shareholders, they will get their dividends, and after that only equity shareholders will get their dividend. And in case of winding up or closing down of the company, the preference shareholders at first they will get their amount, then they will get their capital, and after that only if something is left, then the equity shareholders will get their capital back. Then there are different types of preference shares. The first one is cumulative preference shares. The holders of this class of shares are entitled to all arrears if dividend is paid on equity shares. Suppose let's say through example you will be able to understand properly. A company has issued 1500 shares, preference shares of rupees 10 each, carrying dividend at the rate of 10%, and suppose dividend was not paid for 2004 and 2005. Now in 2006 the company earned good profit, and in that year what they are going to do is that they will pay dividend for 2004 and 5 as well. So means the due for 2004 and 2005 will be paid on 2006 as well. That means arrears for this 2 year will the preference shareholder will get in 2006. Then next is non-cumulative preference share. Now this is opposite of cumulative preference share. In earlier case we saw that the due for 2 year it was given in the year 2006, but in non-cumulative preference share it doesn't happen like that. Means he will not get dividend for 2004 and 5, but he will get dividend for only 2006. Then the third type is redeemable preference share. If preference shares are redeemable out of the profits by the creation of a capital redemption reserve fund, or by new issue of shares, or out of the sale proceeds of the property of the company, they are called redeemable preference share. Means suppose you have purchased preference shares of a company, and after a few years you want to sell your preference share and you want to take your capital, your money contributed in the company, so that you can do if your preference share is redeemable preference share. That means you just have to give your share certificate to the company, and the company will return back your money. Then next is participating preference shares. When preference shares participate like equity shares in the profits of a company in addition to their fixed profits, they are known as participating preference share. Means these shareholders, what they do is that first they will get fixed rate of dividend, and if there is any extra profit left, then they will get a part from that extra profit as well. So that is why they are known as participating preference shares. Then the last type of preference share is guaranteed preference shares. These are the shares at which a fixed dividend is guaranteed by the vendors or some other party. Means if the company is not able to pay the dividend, then at that time any vendor or any other party of the company, they have to give dividend to the preference shareholders. The guarantors will pay the amount. The company itself cannot give guarantee. The guarantee can be given by vendor or promoter of the company. Suppose if in a particular year the profit of a company is not sufficient to pay dividend to all the preference shareholders, then in case of guaranteed preference shares, they will get their dividend from vendor or promoter, as it was already agreed between them. Okay, so for this session we will wind up here, and you go through the different points of this chapter, because this chapter is very much important. So thank you.